Investors have made a mint, and they're still holding out for more. This is a direct quote from a leading investment analyst, and it perfectly captures the gold rush fever surrounding one of Britain's most legendary companies. But this same expert follows that statement with a chilling warning. A company that was trading for less than £1 just 3 short years ago has just shattered a historic glass ceiling on the stock market. But the very engine of its incredible success, the wild optimism of investors, could now be the very thing that triggers a catastrophic failure. So what in the world is going on with Rolls-Royce? Today, we are going to dive deep into the absolutely astonishing story of its stock market triumph, a tale that has captivated financiers and defied all expectations. We will meticulously unpack the secrets behind its gravity-defying climb, a journey from the absolute brink of corporate disaster to the very pinnacle of the prestigious FTSE 100 index. But more crucially, and this is the part you cannot afford to miss, we will analyze the stark and serious warning issued by experts who believe this incredible, seemingly unstoppable ascent has put the company in a dangerously precarious position. In this comprehensive analysis, we will explore: how on earth did Rolls-Royce engineer one of the most stunning and rapid corporate comebacks in modern history? What are the immensely powerful forces, including a major global geopolitical shift, that are acting as rocket fuel for its meteoric rise? And finally, what is the perilous re-rating trap that analysts are now urgently warning about? A trap that could send its stock plummeting back to earth if it makes even a single misstep. Stick with us as we unpack this riveting saga of triumph, extreme tension, and truly tremendous risk. Let's set the stage with the headline news that sent shockwaves through the London Stock Exchange. Shares in the iconic engineering giant Rolls-Royce have officially, for the first time in the company's long and storied history, surged past the monumental £10 threshold. To truly appreciate what this means, consider this. The Derby-headquartered behemoth began a recent trading day with its shares already flying high at 988 pence. But a final, decisive surge of just 1.3% was all it took to breach the historic barrier, with shares proudly changing hands for a staggering 1,001 pence. This isn't just a fleeting moment of market exuberance. It solidifies the company's colossal valuation at £83.5 billion. This number is more than just a figure on a screen. It's a powerful symbol. It is a testament to an epic, almost unbelievable turnaround. To fully grasp the sheer scale of this achievement, you must cast your mind back just 3 years. Imagine the darkest days of the COVID-19 pandemic. Global travel had ground to a halt. The company's unique and lucrative power-by-the-hour business model, where airlines pay for every hour a Rolls-Royce engine is in the air, had been a work of genius. But when the entire world's fleet was grounded, that genius model became a catastrophic liability. The revenue tap wasn't just turned down, it was shut off completely. Airlines, Rolls-Royce's biggest customers, were facing bankruptcy. Fleets of aircraft with its engines sat dormant on tarmacs across the world. The company's revenue streams had evaporated, and its stock was on life support, trading for less than a single pound. The journey from that near abyss, from a price point associated with speculative penny stocks to becoming a £10 titan of industry, is nothing short of breathtaking. This spectacular run has also demonstrated an almost stubborn resilience, shrugging off major market shocks that have rattled lesser companies, including the sharp, fearful sell-off that followed the announcement of President Donald Trump's tariffs back in April. Through it all, the upward trajectory has been almost relentless, a rare and brilliant beacon of light in a global market that has otherwise been shrouded in economic uncertainty and doubt. So the billion-dollar question, or perhaps the £83.5 billion question, is how? How did they possibly pull this off? This wasn't magic, and it wasn't a fluke. It was a perfect storm, a powerful combination of internal fortitude and external fortune. First and foremost is the company's own monumental effort. At the helm of this transformation is a leader, CEO Tufan Erginbilgic, who earned the nickname Turbo Tufan for a reason. He didn't come to gently steer the ship, he came to completely rebuild the engine while it was in mid-flight. He took a surgical scalpel, not a gentle hand, to the sprawling organization, implementing a radical and undoubtedly painful business turnaround. This bland corporate term hides a reality of agonizing decisions, of cutting deep into the organizational structure, of divesting non-core assets, and of streamlining every single process with ruthless efficiency to forge a leaner, meaner, and critically, a much more profitable machine. The spectacular success of these tough internal efforts is now bearing golden fruit. Secondly, the company is on an undeniable winning streak. It is securing more and more high-value contracts, filling its order book for years and, in some cases, decades to come. This provides investors with what they crave most: clear visibility of future revenue and long-term stability. This isn't just hope, it's documented, contracted business. And third, there is a massive external factor playing right into their hands: a profound tailwind from the shifting sands of global geopolitics. This isn't just abstract political talk. We're talking about the direct consequences of the conflict in Ukraine pushing NATO members to scramble to meet their 2% GDP spending commitments. We're talking about the AUK Security Pact between Australia, the UK, and the US, creating sustained demand for advanced defense technology. With instability and conflict simmering, many governments are making firm commitments to significantly increase their defense spending. As a premier manufacturer of advanced military aircraft engines and other critical defense technologies, Rolls-Royce is perfectly positioned to capitalize on this somber global trend. It's that rare good news story, a perfect convergence of internal strategic brilliance and a favorable, if turbulent, external environment. It's a truly fascinating case study of corporate strategy and market dynamics coming together to create incredible value. If you're finding this breakdown of Rolls-Royce's success compelling, take a moment to hit that like button. Your support is the high-octane fuel that allows us to produce more in-depth analyses like this one for you. Now, a compelling narrative is wonderful, but in the cold, hard, cutthroat world of finance, stories don't move markets for long, numbers do. And this is where Rolls-Royce is truly firing on all cylinders. The core mechanism, the very engine driving up a company's share price, is often upgrades to its earnings forecasts. In simple terms, financial analysts meticulously study a company's health and predict its future profit through a metric called earnings per share, or EPS. When those EPS predictions keep getting revised upwards, it sends a powerful, unambiguous signal to the entire market that the company is outperforming even the most optimistic expectations. And according to the analyst Dan Coatsworth, Rolls-Royce's earnings estimates keep going up. This is a critical point. While many other companies are weathering a storm of earnings downgrades, issuing profit warnings amidst the gloom of an uncertain global economy, Rolls-Royce is flying high in the clear blue sky of positive revisions. Let's look at a concrete example to understand the sheer power of this. Just 1 year ago, the consensus forecast for Rolls-Royce's earnings per share for the year 2026 stood at 22.32 pence. Fast forward to today, and that very same forecast has been dramatically revised up to a much, much healthier 28.93 pence. That represents a massive vote of confidence from the financial community. But it is precisely here, at the peak of its ascent, that the plot thickens and the triumphant fairy tale encounters a harsh dose of reality. Every experienced pilot and every seasoned investor knows that what goes up must eventually come down, or at the very least, that flying at maximum altitude requires every part of the engine to perform with absolute perfection, with zero margin for error. You see, there is another, more psychological and potentially treacherous driver behind the stock's incredible rise. And it's this element that has analysts issuing a very serious warning. This phenomenon is known as a re-rating. A re-rating occurs when investors become so overwhelmingly enthusiastic that they are willing to pay a much, much higher price for its shares relative to the actual profits it's expected to generate. Think of it like a house in a previously normal neighborhood that suddenly becomes the next big thing. The house hasn't changed, but the price tag skyrockets based on hype. The most common way to measure this is the price-to-earnings ratio, or PE ratio. Last October, Investors were paying a respectable 24.3 times the company's expected earnings to own a piece of Rolls-Royce. Today, that multiple has exploded to a sky-high 36.3. Let that sink in. To put that into perspective, the historical average for the broader stock market is typically between 15 and 20. Investors are now willing to pay a price tag for Rolls-Royce's profits that is effectively double the historical norm. This isn't just confidence, it's borderline worship. And this is where rational analysis often gives way to raw market emotion. It's the powerful, intoxicating, and dangerous drug of FOMO, the fear of missing out. No fund manager wants to be the one explaining why they missed out on one of the biggest stock runs of the decade. So they pile in, pushing the price ever higher, creating a self-fulfilling prophecy. For a time. This re-rating, while a wonderful vote of confidence, can't continue to expand indefinitely. In fact, it creates a dangerous, high-pressure environment for the company, a kind of gilded cage. The immense problem with such a lofty valuation is that it builds a Himalayan mountain of expectations. The market no longer rewards Rolls-Royce for simply doing well or even for just meeting its already ambitious targets. The explicit danger is that these highly rated stocks can fall back to earth with breathtaking speed if their earnings are merely in line with expectations. To justify that premium price tag, Rolls-Royce has to keep beating those expectations. It has to consistently deliver spectacular, surprise-filled good news quarter after quarter. Think of it like an Olympic high jumper who keeps clearing world records. The crowd no longer cheers when they clear a normal, winning height. They only roar when a new record is set, and by a bigger margin than last time. The day they simply win the gold medal without breaking a record, it feels like a disappointment. That is the incredibly perilous position Rolls-Royce now finds itself in. The very same investor optimism that so brilliantly propelled its shares to over £10 has now become a heavy, almost crushing burden. The company is walking the finest of tightropes, high above the ground with no safety net, where simply meeting the incredibly high expectations could be interpreted as a failure by a fickle market that is now addicted to constant, spectacular overperformance. One slip, one piece of good instead of astonishing news, and the fall could be brutal. The stakes could not be higher. Can Rolls-Royce continue to deliver these knockout results and justify its rarefied valuation? Or is this massive re-rating a beautiful bubble that is just waiting for a pinprick of reality to pop? We will be watching every announcement, every contract, and every market reaction in this corporate saga. So to make sure you don't miss our crucial follow-up reports, please hit that subscribe button and turn on all notifications. So, what we are witnessing with the story of Rolls-Royce is a classic high-stakes stock market drama. Is Rolls-Royce the new phoenix of British industry, reborn from the ashes, stronger than ever? Or is it a modern-day Icarus, flying magnificently on wings of investor enthusiasm, but getting dangerously, fatally close to the sun of impossible expectations? On one side, you have a truly phenomenal British success story, a testament to a brilliant and brutal corporate turnaround, a showcase of industrial resilience and strategic genius. It's the kind of story that restores national pride. But on the other, far more treacherous side, you have an incredibly delicate high-wire act. The company is now trading at a valuation so stretched that it leaves absolutely no room for error. The immense pressure to not just meet, but to constantly shatter expectations creates a significant and ever-present risk. A single quarter of results that are merely good instead of mind-blowing could be all it takes to trigger a rapid and painful correction. The company's leadership team is now in the unenviable position of having to outperform perfection. So we are left with the ultimate question. Is Rolls-Royce's new £10 share price the solid new foundation for decades of future growth, or is it a precarious, beautiful peak built on a fragile mountain of unsustainable expectations? The answer will not be found in speculation, but in the cold, hard numbers of the company's next few earnings reports. They will be the ultimate test. It is not just a financial report. It is their judgment day, and the entire world will be watching.